The U.S. freight market is currently navigating a period of anticipation mixed with a degree of uncertainty. Carriers are optimistic about a potential market recovery by the summer of 2025. They believe that the ongoing freight recession is nearing its end. However, shippers and logistics firms remain skeptical, pointing to past predictions of a rebound that did not materialize. This difference in outlook stems from varying interpretations of market indicators and historical trends. The freight market experienced a downturn in recent times, impacting both trucking and intermodal sectors. Carriers faced pressure from declining freight volumes and downward pressure on rates. Shippers, on the other hand, enjoyed a period of leverage in contract negotiations, securing favorable rates due to the excess capacity in the market. As we enter a new phase, the question on everyone's mind is whether the market is truly poised for a turnaround or if the uncertainty will persist. The anticipation of a market shift is primarily driven by the expectation of increased consumer spending and industrial activity. As the economy recovers, the demand for goods and services is projected to rise, leading to higher freight volumes. Additionally, some industry experts believe that the ongoing supply chain disruptions and inventory imbalances will contribute to a tighter freight market. Despite these positive indicators, skepticism prevails among some stakeholders. They argue that the current economic conditions remain fragile, and any unforeseen shocks could derail the anticipated recovery. Moreover, they point to the possibility of overcapacity in the trucking sector, which could continue to put downward pressure on rates. The coming months will be crucial in determining the direction of the U.S. freight market and whether the optimism of carriers is justified or if the skepticism of shippers will prove to be prescient. The differing outlooks on the U.S. freight market are most evident in the perspectives of carriers and shippers. Carriers, particularly those in the trucking sector, are increasingly optimistic about a market shift in their favor. They cite several factors to support their view, including rising tender rejection rates. Tender rejection rates, a measure of carriers' willingness to accept loads at offered prices, have been trending upwards. Carriers argue that this indicates a tightening of capacity in the market, giving them more leverage in negotiating rates. Derek Leathers, CEO of Werner Enterprises, a major trucking company, stated that market conditions are shifting and pointed to the rising tender rejection rates as evidence of this trend. Similarly, Adam Miller, CEO of Knight-Swift, another large trucking carrier, noted a gradual upward trend in rates based on early bidding activity. Shippers, however, remain unconvinced. Many shippers report securing flat rates in their 2025 contracts and haven't experienced a significant increase in tender rejections. They argue that the current capacity crunch is not as severe as carriers portray it to be and that the market still favors shippers. This difference in perception highlights the ongoing tug-of-war between carriers seeking to maximize their profits and shippers aiming to minimize their transportation costs. The contrasting views are also reflected in the contract negotiations between carriers and shippers. Carriers are pushing for higher contract rates, citing increased operating costs and the need to recoup losses from the previous year. Shippers, however, are reluctant to agree to significant rate hikes, arguing that the market conditions do not justify such increases. The outcome of these negotiations will be a key indicator of the balance of power in the U.S. freight market. The intermodal sector, which involves the transportation of freight using a combination of trucks and trains, is also experiencing a period of uncertainty. Intermodal rates typically lag behind trucking rates, as they are influenced by factors such as fuel prices, rail network congestion, and competition from truckload carriers. While trucking rates show signs of an uptick, intermodal rates have not yet followed suit. This is partly because a significant rebound in the truckload market is needed to drive shippers to choose cheaper rail options. The competitive landscape in the intermodal market is also undergoing a shift. Initial bids for intermodal contracts in 2025 disappointed some providers who found themselves outbid by aggressive pricing from industry giants like J.B. Hunt and Hub Group. These companies are leveraging their scale and market share to offer competitive rates and secure contracts. However, this aggressive pricing strategy has raised concerns among some industry analysts. They question whether such low rates are sustainable in the long run, and if they could lead to a price war that ultimately harms the profitability of intermodal providers. The strategies adopted by different players in the intermodal market will have a significant impact on the sector's overall health and its ability to compete with trucking. The intermodal market is crucial for shippers looking for cost-effective solutions for long-haul freight transportation. A healthy and competitive intermodal sector benefits shippers by providing them with alternatives to trucking, especially during periods of high demand and capacity constraints. However, the current uncertainty surrounding intermodal rates and the competitive pressures faced by providers pose challenges for the sector's growth and stability.